In the commercial world, I see three big risks. And the first one you just mentioned, which is folks that are facing a refinance aren't, because of DSCRs, aren't going to be able to refinance out their entire original loan, their entire existing loan. So what are they going to have to do? Either they're not going to refinance, they're going to be forced to fire sale, or they're going to have to go to their investors and basically say, hey, capital call, I need more cash because I have to bring cash to the table to do this refinance. So that's number one. Number two is simply that interest rates are higher. So anybody that has a floating rate loan is now paying significantly more than they were paying 8, 9, 10 months ago. And that's going to put pressure on cash flow. That's going to put pressure on distribution to investors. And it's also going to kind of alert the banks that these properties might be in trouble. And typically the way things work in the commercial world, in the multifamily world, is if the banks see that your cash flow is getting compressed and you may not be able to pay your mortgage, the first step is they do this thing called lockbox, where they basically say, from now on, we're going to collect your income for you. And if you need to spend it on expenses and stuff, we'll dole it out to you. And then the next step is obviously a little bit scarier. They head towards the foreclosure. So we're starting to hear a lot more about properties going into this lockbox state where banks are basically taking control of the income because they're concerned about cash flow. So number two big risk is just the increase in interest rates, mortgage interest rates. And then number three, we've talked a little bit about the fact that these things called cap rate or rate caps. So a rate cap is essentially an insurance policy that lenders require you to purchase when you get a floating rate loan. They want to make sure that if rates go up too high, that you're covered by an insurance policy that will cover the extra cost. Well, these insurance policies are getting ridiculously expensive.
Let's get right to it, Jay. Are we in a recession? You were on, I think, in August 4th in episode 27, and you said that probably the most important thing was the consumer sentiment. And back then, consumer sentiment in terms of deciding whether we were in a recession was absolutely in the toilet. But it seems to have recovered a little bit. I got a little chart here for everybody to see, but it was like at a 45-year low back in July. It's bounced back a little bit. Has that changed your mind at all? Are we in a recession, Jay?
Well, I have to start with this. So I remember back on August 4th, there was the big discussion. The only thing people were talking about was we had just heard that we had negative GDP for 2 quarters in a row. And the big argument was the White House changing the definition of a recession, or is 2 negative quarters still the definition? And I think I pointed out that I really don't like that definition. It's not a real definition, but whatever, people can say what they want. But I will say that as of last week, we've now seen 2 positive quarters of GDP. So if you're one of those people who back in August was saying, we are in a recession because of 2 negative quarters of GDP, well, I guess you have to admit now that we're not in a recession anymore. And I think that sounds just as ridiculous as saying we were 6 months ago.
Or maybe we were in a recession and now we're just out of it, and maybe we'll do a double dip recession.
Absolutely. And I made the point back then that, yeah, we may have been in a recession back then. We may not have been. We may be now. We may not be now. And it's just a word. It doesn't really mean anything. And so there's no, as far as I'm concerned, and as far as the formal government definition, it's not 2 quarters of GDP. It's more nuanced than that. So let's talk about that. So are we in a recession? So I kind of feel like things are pretty much exactly where they were 6 months ago. Crazy enough. I mean, metrics have changed and we've seen things happen. And not everything looks exactly the same as it did 6 months ago or 5 months ago in August. But from a 10,000 foot view, things are pretty consistent. So what we've seen most recently, I mentioned GDP. We've seen 2 strong quarters of GDP. I believe that the 2 negative quarters we saw, and we talked about this, go back and watch the August episode, were much the result of a big trade imbalance and also businesses stocking up on inventory back in Q4 of 2021 that kind of led to the 2 negative quarters of GDP. I don't think we otherwise would have seen those. And likewise, the 2 good quarters of GDP that we just got out of, there are reasons to believe they weren't quite as strong as they looked. So from a GDP perspective, I think things are pretty much were the same all through 2022. What we did see in December, though, 2 kind of big indicators that showed that things are slowing down. One, consumer spending was down 0.2%. So people were spending less money in December, which seasonally adjusted, that was actually down even more. We typically see higher expenditures in December. And we saw business expenses down, or business expenditures down as well in December. So basically both businesses and consumers kind of signaling that they're a little bit concerned about where the economy is headed. And so that's a good thing to note. Now, one of the things I see here is that back in, I don't know, I guess it was March that we started raising rates last year. There's a lot of talk about the fact that the Fed raising interest rates doesn't necessarily take effect day one, or even month one, or even quarter one. It often takes 6 to 9 months before the Fed raising rates has a significant or a measurable impact on the economy and on inflation. And sure enough, 6, 7, 8 months after the Fed started raising rates, we saw inflation kind of take a nosedive and drop off a cliff. Here we are in December, and we're starting to see slower growth, slower consumer spending, slower business spending. So it's one indication that maybe the Fed is getting what they want. They're getting a slowdown in the economy. They're seeing a drop in inflation. The question is, given that 6 to 9 month lag, have they already overcorrected? Will we be back here again in 6 months on the show having a conversation about how we're in the middle of a recession because the Fed kind of pressed that gas pedal too hard, too quickly, and overcorrected? So
yeah, because we were talking before we came on that if you look at the inflation numbers for the last 6 months annualized, they're basically it's zero. Like if you just continue the rate of inflation or disinflation for the next 6 months that we've had in the prior 6 months, you're basically back at that 2% mark as before. So some people are saying the inflation story is already over because that happened, the first 6 months of 2022. But yeah. Do you think the supply, because one of the big things you were talking about with the supply chains in the last episode, because you would obviously with COVID, I don't know if you can still say that word, but with COVID and everything, you had all these supply side issues, and I think we were still having those. At least in your opinion, we were still having those towards the end of 2021, beginning of 2022. Do you think those have largely resolved, or is that something that's still sort of contributing to the inflation numbers and the pricing?
Well, it's funny because we were talking about supply side issues, and then back in Q3, Q4, we started to see that a lot of big companies were coming out with record earnings. And so the question then kind of begged itself, is this a result, or what we were seeing, was that a result of basically constrained supply, not because the supply wasn't available, but because companies saw an opportunity to kind of raise prices and increase demand and increase their earnings. And so a lot of people think that what we saw in Q3 and Q4 was kind of a fake constrained supply, and that it was basically companies doing profit taking. And so there's reason to believe that might have been the case in a bunch of sectors. Certainly, oil has opened up. We've seen supply of oil increase considerably. Obviously, everybody has their conspiracy theories about oil prices and the election and how they suddenly started to go down after the election and all of that. But the reality is that where we were seeing the biggest supply constraints, and that was in manufacturing, that was in energy. Yeah, those have sort of worked themselves out over the last few months. And that's a big contributor to why inflation is down, because we're not seeing these ridiculous energy costs. We're not seeing ridiculous costs in food, even though there's certain things like price of eggs everybody's talking about. But in general, core inflation is coming down. And you talked about disinflation. We actually, in December, the inflation number was negative 0.1%. So prices actually dropped in December, which it happens occasionally, but we don't see it that often. And that's actually deflation.
Right. And I actually, I did a video, I think last week or something, about this whole idea that when you're talking about inflation or deflation or disinflation, which is just a lower rate of inflation, it never goes up in a straight line. Like even if in this decade, let's assume that inflation ends up being, I don't know, 15%. It doesn't go from 2% to 15 in a straight line. It'll go to 9% like it did, earlier last year. Then it'll go down to 5%, then 2%, and then maybe it'll dip negative, and then it'll go back up to 11. I mean, it'll just be a spike up and down. And then what you need to do is look back for the entire decade and see, well, was it an inflationary decade? How much of an inflation? Was it a really a big deal? I've started to see, well, first of all, here, I don't know if it's just a Southern California thing, but our gas prices have literally tripled. Our gas bill this month, we kind of had expected it, and we hear rumors, but that's tripled. And I'm starting to see our gas prices creep up again after they did they did go down towards the end of last year. So be interesting. But consumer sentiment, because that was a big one for you. What are your thoughts where we are on that? There's obviously been a lot of layoffs, although most of them has been the tech sector. But talk a little bit about the consumer sentiment, since you do believe that's such a huge factor in whether we're in a recession, heading into a recession, or how close we are to a recession.
Yeah, well, I guess I have to admit that maybe I don't know what I'm talking about, because back in August, I thought that consumer sentiment in the low 40s, which literally, I mean, we were in the 70s in April of 2020, like 2 months after COVID. People there was stronger consumer sentiment then than there was 5 months ago. So the fact that yeah, there you go. We were what, 70 something in just after the COVID drop. And then after it bumped back up, then it dropped again into the 40s. And from my perspective, that was like the biggest indicator that we needed to be like knocking at that recessionary door, because people were going to stop spending money. They were going to start saving money. They were going to like be really cautious about work. And we didn't see it. People kept spending money, and people kept acting like everything's fine, even though when you pick up the phone and that consumer sentiment, it's basically it's a poll, it's a phone poll. And it seems like you pick up the phone, you call people, and they say one thing, but then they go out and their spending habits and their other habits are indicating something else. So I don't really know what to read into that anymore. Historically, it's been a great leading indicator, but for the past year or two, it's not been.
Yeah, and I feel like the consumer sentiment, maybe not the consumer, but the executive, like the CEO sentiment, is definitely people are getting really nervous. That's a lot of the layoffs and all that stuff. But I'm seeing some great questions already popping in, and this actually covers a topic I definitely wanted to cover. So I'm going to go with Lyle's question real quick. Lyle says, it seems that the Fed rate escalations are only now starting to negatively affect sponsors and borrowers on the short-term debt. And that's kind of the lag effect that Jay was just talking about. It takes about 6 months. They've gone up from 3.5% to now 7 or 8%. Yikes. Isn't that going to create more deal stress in single family commercial for the first half of this year? And this is probably, Jay, we talked a little bit about before we came on, but there's a Fitch report statistic that's making the rounds on the social media on commercial real estate and single family that says there's 23% of the loans that are maturing in 2023 are not going to be eligible or be able to refinance because of primarily the low debt service coverage ratio, and obviously cap rates just continuing to increase. So let's address that. Like, how is this all? The lag seems to be kicking in. How is this all going to affect? Let's take it. Those are two different markets. Let's talk commercial. I know that's your world. Let's talk commercial first, and maybe have some thoughts on single family.
Yeah, so in the commercial world, I see three big risks. And the first one you just mentioned, which is folks that are facing a refinance because of DSCRs, aren't going to be able to refinance out their entire original loan, their entire existing loan. So what are they going to have to do? Either they're not going to refinance, they're going to be forced to fire sale, or they're going to have to go to their investors and basically say, hey, capital call, I need more cash because I have to bring cash to the table to do this refinance. So that's number one. Number two is simply that interest rates are higher. So anybody that has a floating rate loan is now paying significantly more than they were paying 8, 9, 10 months ago. And that's going to put pressure on cash flow. That's going to put pressure on distribution to investors. And it's also going to kind of alert the banks that these properties might be in trouble. And typically the way things work in the commercial world, in the multifamily world, is if the banks see that your cash flow is getting compressed and you may not be able to pay your mortgage, the first step is they do this thing called lockbox, where they basically say, from now on, we're going to collect your income for you. And if you need to spend it on expenses and stuff, we'll dole it out to you. And then the next step is obviously a little bit scarier. They head towards the foreclosure. So we're starting to hear a lot more about properties going into this lockbox state where banks are basically taking control of the income because they're concerned about cash flow. So number two big risk is just the increase in interest rates, mortgage interest rates. And then number three, we've talked a little bit about the fact that these things called cap rate or rate caps. So a rate cap is essentially an insurance policy that lenders require you to purchase when you get a floating rate loan. They want to make sure that if rates go up too high, that you're covered by an insurance policy that will cover the extra cost. Well, these insurance policies are getting ridiculously expensive. Just to give an example, we bought one on a property for $30,000 a year back in 2020. We have to renew that one in September. If we were to renew it today, it would be $540,000 per year. So basically, we've gone from $3,000 a month to $45,000 a month for this insurance policy. There are a lot of owners out there who are in a situation where they're going to have to renew that insurance policy this year or next year. And if rates are still up in the 6-7 figures, which we're seeing in some cases, they're going to have trouble making those insurance policy payments. They just don't have enough NOI, enough cash flow. So those are the three big risks I see. Now, here's something really interesting. I was talking to Ashley Wilson, my business partner, who today is in Las Vegas for this conference called NMHC, which is the largest multifamily broker conference in the country. And she was talking to some brokers today, specifically in the Houston market where we have properties. And she was asking the question, hey, should we expect these three big risks to be playing out and seeing some really good deals this year? And what she was told by a couple of the brokers was they have not seen a single deal that has gotten into financial trouble where the bank hasn't stepped in and said, let's negotiate, let's figure this out. So
that's interesting.
At least, yeah.
That's interesting that you say that, because that's kind of the not the rumor on the, maybe there's a rumor on the street that, yeah, we're going to have all these things that are going to come up for renewal that nobody's going to be able to do, but the banks are just going to do loan mods. They're going to negotiate. They're going to step in. They're going to figure something out for them. And I've always been a little bit like cautious or maybe cynical about that, but it sounds like that's what the street is saying. So those are brokers are saying that that's the plan.
Yeah, and it makes sense. I mean, if you think back to 2008, one of the big issues that lenders got into was they immediately started taking back all these properties, especially in the single family space, and they had too much debt on their books, too many properties on their books, and that basically got them in trouble with regulators. So I wouldn't be surprised if there are a lot of banks right now that are waiting to see how this plays out, and they don't want to get into this habit of starting to take back properties right away, because if things get bad, they're going to end up with too many properties on their books. So I think they're probably being a little bit more cautious, and that could change. But yeah, it sounds like as of right now, those great deals aren't necessarily going to be hitting the market as abundantly as we were hoping, just because banks seem to be willing to negotiate.
Yeah, I've been hearing a lot of people wanting to put together these sort of vulture funds, or sort of similar to what we experienced right after the whole COVID thing. So everyone's expecting 2023 to be a huge buying opportunity. Although we've seen drops, right, Jay? You're seeing 10, 20% drops. Is that kind of, what's the number of prices that you're already seeing commercial that you're seeing?
Well, it's interesting. We saw 10 to 20% drop in late spring and summer, but we haven't seen much of a drop since then. So transaction volume has kind of fallen off a cliff. We're not seeing many properties transact. Sellers aren't willing to bring their prices down. Buyers really aren't willing to come up yet. So we're not seeing much in terms of transaction, but we're not seeing prices drop much since the summer, but we're still down 10 or 20% off the peak. And I think that's pretty consistent across markets from what I've seen and talked to other operators.
So would you say that the fund managers that are starting to put together these vulture funds anticipating 2023 are going to be a little bit disappointed? They're going to have to maybe wait a little bit longer? Or what would you say? What would you say if somebody came to you and said, hey, Jay, I'm thinking about putting together a vulture fund to take advantage of these great opportunities in 2023? What would you tell them?
So the financing and the debt side is one big issue owners are facing. And right now, it's the only issue. The question is, are they going to be facing other issues in 2023? So, for example, if we start to see mass layoffs and unemployment spike, then we could see vacancy spike. And when vacancies spike, obviously income drops, and then owners are facing other issues besides just debt. And those are things you can't negotiate away with the bank. You can't go to the bank and say, hey, my occupancy just dropped to 85%. What are you going to do for me? So if we start to see other issues outside of debt issues and interest rate issues in 2023, and I think it's very possible. I expect that we're heading into a recession. I expect that part of that is going to be a spike in unemployment, and part of that is going to be a decrease in occupancies. That, yeah, I could still see some great deals coming about in 2023, but it doesn't look like it's going to be happening in the next month or two or three at least.
Right. Well, you mentioned unemployment. I did want to talk about that because, we were talking again, I think I got a graphic here as well, but, when we talked 5-6 months ago, unemployment was at 3.5%. I got a little graph here, and it's still 3.5%. But if you notice the amount of jobs being added, I think the jobs report had literally just come out. It was like 530,000 new jobs had come out in July, and everybody was saying that that's not a sign of a recession, but it has come down significantly. And in December, we only added 220,000. So that's trending in that direction. But employment, obviously, or unemployment, is such a big factor in the recessionary story. What are your thoughts on where unemployment looks like it's heading when we get back together in 6 months from now? You think unemployment is going to be significantly higher?
Well, obviously tech is dominating the headlines, and everybody's seen that, like, companies from Microsoft to Spotify to Google to Meta to everybody is laying off. I think it's over 100,000 now in Silicon Valley. So that's kind of been dominating the headlines. What's not dominating the headlines is that we're seeing a spur in hiring in other industries like healthcare and hospitality and even construction. So, and as we've seen, I mean, unemployment is stuck at 3.5%, historic lows. So we're adding as many jobs as tech might be cutting. But one interesting data point that I heard just a few days ago was that there's this thing called temporary help, which is basically companies that hire part-time or, again, temporary help. And typically it's a great leading indicator. And what we see is, as companies start to lay off, they don't lay off full-time employees first. Who they lay off first is these temporary employees, these part-time employees, and this temporary help. And so what we've seen is that the unemployment or the layoffs for temporary help has been significant over the past 3 months. So we have negative growth in temporary help. And so if you look back at the last few recessions, this has been a very good leading indicator that CEOs and companies are starting to get concerned, and that often drives the recession itself. So from a jobs perspective, and just look at that 3.5% unemployment number, everything looks great, but temporary help is certainly looking worse. Another interesting thing to notice, and everybody was talking, especially 5 months ago, about the fact that we were seeing big negative real wage growth. So wages were growing a lot more slowly than inflation. So people's spending power was dropping considerably. Well, the interesting thing is, now that we have a full 2022 worth of data, what we found is that wage growth in 2022 was about 4.6%. Well, what was inflation in 2022? Wasn't much more than 4.6%. So in terms of wage growth and where, like, what we call real wages modified for inflation, we're basically where we were at the end of 2021 here today. So in some respects, the employment and the wage growth and those numbers aren't looking as bad as they did. So again, it's a really mixed bag. And things are different than they were 5 months ago, but it's hard to say that they're any better or worse.
Yeah, that's interesting. And one of the other things I've been seeing quite a bit, and I know this gets a little bit technical and I don't want to necessarily bore people, but one of the big indicators of recession traditionally has been these inversion of yield curves. And we talked a little bit about it last time, but the inversion's just gotten worse and worse and worse. And I think I haven't looked at it recently, but I think the 2-month bond is trading at a higher interest rate than a 30-year bond, which is like, makes zero sense, right? You'll actually get a higher rate if you lend somebody for 2 months as opposed to the 30. So that's just telling us something's brewing. We don't know exactly what it is, but certainly the market isn't very happy and has an expectation of something going south. You want to kind of give a high level thoughts on yield curve without losing too many people?
Yeah, I won't get technical, but suffice it to say that we see this inversion of the yield curve. So we see this switch between typically 10-year rates are higher than 2-year rates, because you have to commit to this bond for 10 years versus 2 years, and they pay extra to do that. When we see that kind of change, 2-year or whatever, go higher than the 10-year, it's typically because investors are really confused about what's going on in the economy. They start pulling money out of stocks, they start pulling money out of real estate, and they think, okay, while I'm confused, I'm just going to park my money somewhere that's short-term and safe. So they'll pick a 2-month or a 6-month or a 1-year or a 2-year bond, while they say, okay, I'm going to sit here and wait to see what happens. Well, when a lot of people start to do that, there's a lot of demand, and so it causes bond prices to do this weird thing. Long story short, but we see this inversion when investors are really confused and don't know what's going on. As of a few weeks ago, we saw literally the largest inversion in the yield curve in history. And so a lot of people are saying, well, that's an indication that investors are more confused than they have been in a long time and to a large degree. And I agree with that. I mean, I'm sitting here saying that things are looking good, but I think we're heading towards a recession, but there's some negative indicators, some good. So I think a lot of people are kind of in that we don't know what's going on, and 3 months from now could be exactly the same or completely different. But if it's different, is it better or worse? Nobody knows.
Right. And the important thing for me though, that I just kind of understood a couple of years ago now is that, this is it should be the bond curve, the yield curve should be self-correcting, meaning if suddenly the 2 year, or in this case, the 2 month, if that interest rate is high, then that you would think that investors would then sell a longer, the 30-year bond in order to purchase a 2% bond, because that's now I'm getting a better return. And so that usually is what happens, and that drives interest rates down. And then that kind of self-regulates the curve. But something's going on where people are not comfortable selling their 30-year bonds and putting it into 2-year bonds, and because they're nervous, they're concerned about the future, and as that curve inverts even deeper and shorter, because when we talked back in December, it was literally probably the 10-year and the 30-year had inverted, but then the 5-year and the 30, and now the 2-year, and now the 2-month. The fact that a 2-month bond is yielding higher than a 30-year bond tells me that something is that the market part, and we're talking about market participants. We're talking about pension funds. We're talking about sovereign wealth, and we're talking about huge amounts of money who are putting, governments who are putting together, who are putting trillions and trillions and trillions of dollars at work. They're concerned about something. So that's just something to pay, at least if nothing else, pay attention to that.
And it's worth noting that when it comes to the yield curve, historically, and not in every case, but almost every case, when we see an inversion, it's a predictor of a recession within 6 to 18 months. And so, but we were seeing these yield curve inversions last July. So a lot of people were thinking that by early this year, we would be seeing something that looked like a recession. Haven't seen it yet, but that's still an indication it's coming.
Do you think it's going to be some major event, some black swan, some sort of, Lehman Brothers collapse, or just some event you literally wake up one day and something happens and, oh my God, everything collapses? Or you think it's more of a gradual? I mean, you're a student of this, so I don't really pay attention to how it's happened in the past, but in the past, has it been more gradual and you just kind of fall into the abyss, or has it always been something happens, either somebody invades something or some major company goes bankrupt? What would you expect if we were to go into a recession? What would you expect something like that to be triggered by?
It's typically something, but it's not an event. So it's an asset bubble. So in the 70s, we saw an energy bubble. Price of oil got ridiculously high. In the 80s, late 80s, we saw this thing called the savings and loan failure. So a bunch of these banks, before there was FDIC, like there was runs on the banks, and all these banks started to fail, and that caused a problem. In 2001, it was tech. Then obviously 9/11 didn't help, but we saw this collapse in tech. And then 2008 was obviously all the collateralized notes and the banking practices and the mortgages. So it's generally like an industry imploding as opposed to a single event. But it's not clear what that industry would be right now. Obviously, people are talking about real estate being in a bubble. People are talking about stocks still being somewhat in a bubble. But it doesn't look like either of those are going to lead to it. It could be something as I don't want to say mundane, because it's certainly not mundane, but it could be something existing. So, for example, we still have the Ukraine stuff going on, and so that's making energy and food distribution around the world much more difficult. So it could be that. It could be the China lockdown. So if there's another wave of COVID in China and they lock down again, well, we could see supply chain constraints.
Or Chinese invasions.
Well, yeah, certainly there could be another war. And then inflation. So then there's this idea that you've talked about, the 1940s inflation, where we saw bad inflation, we kind of squashed it and it went away. And then there's the 1970s style inflation, where it goes up, the Fed squashes it, and then it comes back. And then the Fed squashes it and comes back, and over. And we saw 4 recessions between the late 60s and the early 80s because inflation just kept coming back. Is that going to happen? Right. So it could be a lot of things, or it could just be one of those, like, we've raised interest rates too much. The Fed's overcorrected. People don't have the money. Housing's too expensive, and we just see this slow, descent into slowing growth and a recession.
Yeah. And Jay, you wrote in your last, you put together this great weekly newsletter. And if you guys haven't read it, I would recommend you guys going to bardowninvestments.com to look at Jay's weekly. It's just all macro, which is kind of a fun, mostly macro. I think you've done a little bit of really, but mostly macro. So we'll put that in the show notes. But you said something interesting in your last one that I wanted to read it back to you. And then I wanted you to expand on it. You said, in your opinion, we won't see a transition away from real estate, but we will start seeing a transition away from debt. What do you mean by that?
Trying to remember where I wrote that.
I think it was in your last newsletter. So do you think real estate is going to come under pressure and you're going to see some massive drops, or do you think people are just going to begin to unlever and have less and less debt moving forward, and that's how people are going to solve their problems?
Well, I think the bank's already solving that problem for them. So we're seeing a lot less. We're seeing lower LTVs, lower LTCs on the debt side because DSCRs, because these properties have to pay a lot of money for their mortgages. They don't have as much money to get as big a mortgage. So lenders are lending a lot less than they were, which means that in the commercial space, especially in the syndication space, that means that operators need to raise more money. And so what they're doing is they're trying to get creative and figure out how can they raise money in ways that are lower cost of capital than traditional, go out to investors and offer them 14 or 16 or 20% returns. And so I think we're going to start seeing more of these creative type deals. We've just recently launched this thing called a preferred equity fund, which is kind of a hybrid. I don't want to, not truly hybrid debt and equity, but it kind of works in a way that looks like hybrid debt and equity. And I have a feeling we're going to start seeing more of those because, the banks are already regulating debt. And I think that we're going to see situations where a lot of deals just aren't going to pencil for a long time. And so the question is, are sellers going to be desperate to sell and drop prices so that they do pencil for buyers, or are they not? And then we just won't have any transaction volume for a couple of years.
Yeah, that's an important thing. Actually, this is something I actually learned when we had Eric Stewart on the show, where, I was under the impression, mistakenly, that banks were simply not lending. They were getting nervous that everything was a little bit frothy and that, they were only lending 65, 70% LTV because they were nervous. And if the banks were nervous, what does that tell you? But in reality, like you mentioned, it's just that the numbers don't pencil out, that the debt service coverage ratio isn't there in order to support. But if it did, the banks are still happy to lend you 80, 90%, maybe not 90, but 80%, 75, 80%. It's just that the numbers don't work out. So the banks are only lending you. It's not that the banks are only lending you 65%. It's just your deal just doesn't pencil. So you've got to put down more of a down payment, 35% plus your rehab costs and everything, your value add. And so we're seeing sponsors having to raise a lot more cash to take down these deals.
Banks are desperate to lend. In fact, I heard a couple things today in that regard. Number one, for banks doing, maybe it's agency, so Fannie Mae, Freddie Mac, for loans under $7 million, they're now willing to give a concession of 40 basis points or 0.4% on the interest rate and an extra year of IO to kind of spur these deals in the sub $7 million range. Excuse me. So that's number one. And then number two, Freddie Mac a few months ago announced that they were going to allow operators to basically lock an interest rate at the time they applied for the loan, which historically has not been the case. You basically apply for the loan, you get approved, and once you get the approval, you can do your rate lock. But the banks were realizing that rates were fluctuating so much that buyers were hesitant to start the process because they were concerned that by the time they actually got to the point where they could lock the rate, it would be much higher and the deal wouldn't pencil. So Freddie Mac said, yeah, submit an application for a loan today. We'll let you lock the rate at today's rate for a little bit of a premium. So banks are really working to try and make these loans.
Right.
They're not shying away.
Right. And you think interest rates will be higher or lower, thus helping or hurting the ability of the banks to issue these loans?
So I think we have our next potential rate hike tomorrow. So
it's a done deal. Let me just tell you right now, it's a 0.25. I think it was a 98.5%. The market was saying it's a point. So I will be shocked if it's anything other than 0.25, because just for everyone, it's like the Fed's really into this expectation policy thing. So they don't want to rattle markets. If they wanted to raise it by 75 basis points, for example, they would have started leaking that out. They would have had some talks, and they want the market to adjust. They don't want to jolt. So I can't imagine. I mean, I'm saying it's a foregone conclusion that it's 25. I'm going to be much more interested in the language and sort of the projections that they're going to be giving, because but in terms of interest rate, I can't imagine them going anywhere. So sorry, I interrupted you. You're going to say something there.
It's okay. I think so. They're going to do a 25 basis point, 0.25% hike tomorrow. My expectation is the language is going to be that we're cautiously optimistic. We're seeing inflation under control for the time being. We're seeing consumer spending and growth slowing down a little bit. And they're basically going to take this cautiously optimistic stance, which is likely going to mean that they'll do one more interest rate hike again when they meet in March. And assuming inflation numbers are still looking good, I wouldn't be surprised if they at that point signal that they're going to stop for at least the time being. And once the markets get wind of the fact that the Fed is likely to stop raising, we're going to see a whole lot less volatility. And I think we're going to start to see mortgage rates come down. Now, we're not going to see mortgage rates drop below 5%, for example, until we get interest rates obviously start to drop. Right. But I think that we're going to see that delta between the federal funds rate and mortgage interest rates start to drop as volatility comes down and people are less concerned that rates are going to continue to rise.
Let me know if you agree with me, but I'm in the camp that the Fed's fund rate will actually start being cut probably in 2023, because there's going to be some liquidity event. I mean, liquidity is already starting to dry up a little bit, but there'll be some black swan, some liquidity crisis where the Fed will have to come in and actually totally reverse course, not because they want to, but they have to, because, whatever, the repo market blows up or just the credit markets freeze or whatever. Do you agree with that? Or do you think if the Fed wants to maintain interest rates or increase them or do whatever they want, that they have the ability to do that?
I mean, I'm not seeing any signs of a liquidity crisis right now. So banks seem to have plenty of reserves. We have this thing called the reverse repo market, where basically banks take any extra money they have and they try and get rid of it overnight so they can make a little bit of interest on it. And last time I looked, it was somewhere between $1 and $2 trillion.
Crazy, yeah, it's crazy.
So there seems to be bank liquidity. Whether there's market liquidity, there's no reason to believe there's not. I don't know really how you measure that on a day-to-day basis. So it certainly could be an issue, but we're not seeing, or I'm not seeing anything right now that says this is going to be the big issue or a big issue in the near future.
That's awesome. I'm going to replay this clip in 6 months when we get together again. Drew asks, we were talking about the bond bubble. So I'm a little bit like, if you guys have questions, please drop them in the chat. We're happy to answer. Drew was asking basically when we're talking about bonds, are we in a bond bubble this time? He's been hearing that term thrown around a lot. And I know you're not a big fan of these terms that get thrown around, but are we in a bond bubble?
Yeah. So we have this situation where stocks are underperforming and but interest rates are going up, and it's kind of not something we normally see. Typically, we see interest rates go up before a recession, and that kind of causes a recession. In this case, we're kind of seeing interest rates go up sort of during a recession, if that's what you want to call this. And so it's weird to kind of see bonds as strong as they have been, but we're seeing bond yields like just going up and up and up, which typically we don't this time of this part of the cycle. And so I think this is a bubble. Now, is a bond bubble bad? I don't know. I mean, there's certainly some negative effects from the perspective of the government is going to spend more or to create more debt because Treasury yields are higher, and so it could. And maybe this is a good discussion to have. Like, will it impact the national debt? We're facing a debt ceiling crisis right now, so maybe that leads in that. So yeah, I think we are probably in a bond bubble, but I don't see a lot of necessarily dire consequences from it in the near term.
I would also argue that we were definitely in a huge bond bubble when interest rates were at zero, or when the 10-year was at below 1, and that, I would argue that bond bubble kind of burst as interest rates went all the way up to where they are now. Because the interesting thing about the interest rate, it's not necessarily the absolute number, but when you look at the rate of increase, I mean, going from 0.025 to where we are now, 4.5%, or the 10-year going from -1 to wherever it is now. I haven't kept track, but it's like quadrupled or tripled or quadrupled. It's not so much the absolute points, and that does run havoc on companies, and there is a lag effect, and at some point it's going to catch up. I don't know when, but it's going to start catching up with people.
Yeah, and I think to that point, that's, I think the big risk here is that it used to be if Walmart needed to raise money, they could issue bonds at 7-8%, and people were like, Walmart's low risk. I'm happy to buy Walmart bonds and get my 7 or 8%. Well, now they can get like treasury bonds or municipal bonds at 5%. And it's like, that's zero risk.
Right.
So do I want to go with the 7% Walmart bond that's relatively low risk, or the 5% municipal bond that's zero risk? Or do I want to, and then bigger companies like, so startup tech companies and mid-sized tech companies, they used to rely on bonds at like 8, 9, 10%. But again, if you can get municipal or treasury bonds at 5%, you're not going to give a startup tech company your money for 8 or 9%. So now what we're seeing is that these companies, everything from Walmart to Google to small and medium-sized tech companies, have to offer like 12% bonds, and they can't afford to do that. They can't do that. So these companies are going to have a lot of trouble raising money over the next 6 to 12 months, which means they're going to have to cut costs. They're going to have to hope that they have investors that are willing to bring more money. And if they can't do that, you're going to see a lot of these small and mid-sized companies that start to go out of business. Walmart's not going to be in trouble, and Google's not going to be in trouble. They'll figure it out. But there's a lot of small and medium-sized tech companies that are not going to be able to raise money through bonds or investors, and they're just going to go out of business.
Yeah, and even in our world, I mean, people are doing hard money. We're doing hard money loans at 10 or 12%, which, when you could only get, 0.5% somewhere else, that sounded like a really great deal. But it's not that 12% isn't a good deal anymore, but it's only not as good a deal as it was. It's almost like you have to adjust that. So, 12% doesn't cut anymore. Jared, we can definitely not have a live without a standard blockchain question. So I appreciate you, buddy. But this actually is a little bit more to do with central bank digital currencies. And so I know that the Fed already talked about some experiment. They're already doing some experimental stuff. I know China's already introducing it. General thoughts on central bank digital currency, how that would affect the state of, well, how the economy really works in general if we had a central bank digital currency that I think a lot of people are starting to talk about as almost a foregone conclusion here in the next 5 to 10 years. By the way, just a quick story. I was in Atlanta not too long ago for an event, and I was at Starbucks in my hotel, ordered my coffee, went to pay with cash, and they're like, we don't take cash anymore. Not that that's the same thing as central bank digital currency. That's just obviously they're just taking credit as opposed to cash. But anyway, do you think central bank? What are your thoughts in general on CBDCs?
I don't have a lot. I think it's foolish for us to think that we're not heading in that direction. I mean, to a large degree, we've been moving in that direction for the last 20 years, 30 years. I mean, a lot of, not necessarily a digital currency from the consumer standpoint, but a lot of what happens behind the scenes, bank to bank, Fed to bank, bank to institution, is just money on a ledger. And maybe it's not blockchain as the ledger, but it's a ledger nonetheless. And so this is kind of like what we're likely to see over the next few years is kind of that last mile. So we start to see the digital move from behind the scenes to in front of the scenes. And I don't think we can stop it. Do I think it's a bad thing? Certainly, if you don't trust the government, which I'm not a conspiracy theorist, and I'm not somebody who says I think the government's out to track my every expense and to control me. But by the same token, I know that the government is going to do what they can to manipulate the economy to their benefit. And so having the government be able to track all transactions is a little bit scary. And so, yeah, I don't know what it means. I know that I'm not a huge fan, but I think there are going to be benefits at the same time. And I think it's going to make things easier. I mean, hopefully at some point I can wire money without paying $30 and having to walk into a bank to get money from one account in one bank to an account in another bank. That'll be a good thing. But certainly the insight that the government and the institutions will have over every transaction we're making is not necessarily a good thing.
I know that Jared and Courtney, hey Courtney, both would love to start the conspiracy theories as well. But the one thing about the central bank digital currency, which I haven't been able to wrap my mind around this, but as we should know or do know, that the Fed is really owned by the banks, right? The commercial banks. Those are the actual shareholders. Not that it's a company, but I just see a hard time having the banks acquiesce to the Federal Reserve taking over what they do. Like right now, they're the ones that actually create money. Those commercial banks, instead of that sort of turn that over directly to the Fed so that the Fed can just create money themselves directly and have, every citizen have a checking account with the Fed. And if they need to wire you money, they'll just wire you money and bypass the commercial banks.
It'll be interesting when you don't go apply for a loan, when basically all the information's there, and at click of a button you can see if you qualify and for how much, because all the data is online and it's all been synthesized before you even start the process. And so, is that a good thing? Is that a bad thing? It might be good from the consumer's perspective to some degree, but yeah, I think it does take a lot of power out of the hands of the banks, and I'm not sure they're going to allow that to happen easily.
And that at the end of the day, where it relates, let's bring it back to the economy. That really just relates to how money is created, and therefore how much money is circulating. I won't say money, it's a loose term, but money is circulating in the economy. It comes towards inflation. Sort of lifting a lot of constraints that may occur now, because you do still have the constraint that the commercial banks do still have to lend most of the time. So it's just an interesting thing. But I'm seeing the conspiracy theory already flying around, but unless we get another question, I'm going to get going with these conspiracy theories. But so maybe we can sort of maybe wrap it up, and because I know we have a lot of real estate investors, even if they're not syndicators. So generally speaking, if you have you are a syndicator, and I know you're buying stuff, but give us your projection here for the rest of the year. If you're a real estate investor, should you be acquiring? Should you be careful? You should be sitting on the sidelines? Should you be waiting? What advice would you be giving to real estate investors in this particular market?
So I would suggest people stay away from short-term transactional deals. Flipping is probably not something, and I'm the guy that wrote the book on flipping houses, and I'm not saying don't buy the book. Buy the book. No, I'm just kidding. I've always said there's rarely a bad time to be flipping houses, but this is one of those times. We don't know where the market's headed, and it could change very drastically and quickly. So right now, I wouldn't be focused on doing any type of transactional real estate, like 1, 3, 6 month type deals where you're reliant on being able to sell on the back end quickly. That said, when it comes to investments, buying stuff that you can hold for a year or 3 years or 5 years or 10 years, we say this in this industry: if the numbers work, the numbers work. And if you can find a deal where you're cash flowing today, when interest rates are lower in a couple of years, you're going to be cash flowing even more. So don't not do a good deal, or don't not do a decent deal today because you're worried about where things are headed. Once the deal's locked up, if you can lock in some decent long-term fixed rate debt, or even if you can lock in some decent longer-term floating rate debt, but you can fix it for a couple of years. We talked about this last time. Historically, when we start to see interest rates rise, over the last 10 cycles of interest rates rising, what we've seen is that the Fed has started cutting rates within 2.2 years on average. And the longest they've taken to start cutting rates after they've started to increase them has been 3 years. So assuming that we kind of fit into that historical model over the last 10 cycles, you can expect that if rates started to go up in the beginning of 2022, that on average, we should expect them to start going down beginning of next year, and the longest would be the beginning of 2025. So if you can get debt that is fixed rate, even if it's floating debt or short-term debt, if you can fix it for 2.5, 3 years, you're probably in decent shape. So don't shy away from a decent deal. Likewise, in the commercial space, a lot of the deals that we do in the syndication space, whether it be in multifamily or some other asset class, our horizon is typically 3 to 5 years. So if you can make the deal work with today's debt in today's environment, with today's rate caps, the deal's only going to get better in a couple of years. So don't rush into deals, but don't sit on the sidelines and feel like now's the wrong time.
Yeah, and I think I probably should have. I think I kind of did, but I should have defined the, what short term or long, because your time horizon is critical. I mean, Drew's asking is a 3-year business plan in multifamily too short term to buy? But that's such an important point. I've been having this discussion with my sister because both she and I are actually looking to buy a single family, our forever home. And if your time horizon is forever, meaning you don't plan to sell, you plan this is your final home and you don't plan on ever selling, then the price really doesn't matter too much. You can always refinance the high interest rate whenever they come down. But to your point, if your time horizon is 6 months because you're flipping, that's different. Or if your time horizon is, I got to get my money out in 2 years. But it sounds like 3 years is, would you say that's a sweet spot? That's kind of no longer short term?
I think it's still a little short. I think as long as you can afford to hold for at least 3 years, you're probably okay. But I think what we're going to see in the multifamily space is that we're not going to be doing these value add deals where we tell investors we're going to sell in 3 to 5 years and then sell 18 months in, for the simple reason that a lot of the reason we were able to get that over the last couple of years is because we saw, number one, tremendous cap rate compression. I mean, cap rates just dropped and dropped and dropped. They haven't expanded that much. They've gone up maybe a quarter point, maybe a half point. So best case over the next couple of years is likely that they go back to where they were a quarter or a half point ago. So we're not going to see tremendous cap rate compression over the next couple of years. And then number two, we're probably not going to see natural rent growth like we've seen over the last couple of years. I mean, since COVID, markets have seen 6, 8, 10% rent growth. And we're just not going to see that anymore. We'll probably see the historical 2, 3%. And so it makes it really difficult to get those quick NOI bumps from just natural appreciation. Now, there's still going to be potentially some really good value add deals out there. So if you can take down a deal that you can do some major renovations and push up income, or you find a terribly mismanaged deal where you can improve management and increase management efficiency, lower the operating expenses, you're still going to be able to do these deals. But again, don't expect that it's going to be like the last couple of years where you're holding for a year or two and then selling for double what you bought it for.
Yeah, I was talking to Ken McElroy a couple of weeks ago, and he runs a huge, not only does he own property, he's also one of the large property management companies, right? He's got over 200 people, 200 employees. He across the board, he has about 10,000 units, is not raising rents as they come up right now. He's just keeping them flat. They've had a great run. They just want to keep that occupancy high, and he's instructed all of his property managers to just renew at the current rate with no rent bumps. So I thought that was interesting, a good data point. We certainly aren't going to be seeing these 19, 20% rent growth that we were seeing in some of these markets last year. And by the way, that's a great point. Ashley, your partner, Ashley Wilson, was on, I think episode 44, I think it was. And she did a great, Jenna was a great presentation, but she also talked about the whole issue of people really, a lot of syndicators, a lot of real estate investors hitting their marks because of cap rate compression and other things like that, as opposed to really increasing NOI and actually gaining that by grunt work. It really was the market bailing them out, and they're not getting bailed out anymore, at least in this little thing. Hey, Jay, is Kyle going to officially change his name to Ashley Wilson's husbands?
Well, I guess I can use this as a plug. So the reason there is Kyle and I, my business partner, Kyle, Ashley's husband, have a new podcast that's a couple months old called the Bar Down Investing Show. And he kind of introduces himself as Ashley Wilson's husband. So, but if anybody's looking for a good podcast, we talk a lot about stuff in the economy and multifamily and the housing sector. And we talk a lot about macro type stuff. Check out the podcast. We'd really appreciate it.
And I was actually had the pleasure of being on that podcast while we were down here in Bigger Pockets. And I thought the name of the podcast was going to be the Drunk Real Estate Podcast. I thought that was the official name of it, but apparently we just got a little bit of a series. So check that episode out.
We have investors. We have to be careful.
So if you want to see both of us doing a podcast with a couple glasses of wine, that might be something you want to check out. Hey, before I let you go, best place for people to find you, what's going on in your world? Just let people know where they can find you.
Yeah, I'll pitch here for just a few seconds. I don't normally, but I happily will. So check out the podcast, the Bar Down Investing Show. If anybody is looking for a lower risk investment than traditional syndications, we recently launched something called a preferred equity fund, and I can tell you all about that. But it's for accredited investors. So if you are one and you're interested in learning more, contact me. We got voted today. It was just announced, the Apartment Association, the Apartment Owners Association of America and Rent Magazine voted our coaching program as the number one multifamily coaching program in 2022.
Wow.
So I'll do a little pitch for that. If anybody's looking for some
Nice.
multifamily coaching, reach out to me. And other than that, if anybody wants to get in touch with me, I'm always happy to chat or correspond by email, answer questions. www.connectwithjscott.com.
Great website. And Jay's in the Real Estate Syndicator community on the Facebook group. So he's always hanging out there. So if you've got any additional questions that come up later, just pop them in there. It's mauriciorauld.com/FB group. But we'll put all that contact in the show notes when it comes back. And again, if you need to find either one of us, just go to the Facebook community, Real Estate Syndicator community. And thanks so much for joining us. And thanks, Jay. I know you're not feeling great, so I really, really appreciate your time today. And looking forward to reconvening in 6 months to see how we're doing.
Let's
It's
do
been
it.
fun. Sounds like
Thanks,
fun.
everybody.
Thanks, buddy. Appreciate it.